Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. We're going to run through Twitter like we normally do, generally related to three different topics that we talk about: finance, commodities, and or wealth building. I'm going to sprinkle in my opinions as we go. Let's just dive right in and see what's going on in social media. You want to follow me at Finding_Finance. If you want to join our community, finding-value.com, where I dive deeper into the commodity sectors to find undervalued picks that have explosive upside, is what I'll say. We do have a coupon code MAYDAY, MAYDAY, if you're interested in joining for some savings. And there's a bigger amount of savings on the yearly membership. And if anyone's on a monthly membership, you can always go to the yearly and grab those savings if you're interested. So Uselink, Casper, he's saying this is the last dip before platinum breaks above its neckline at the 1080, $1,100 level there. Then platinum is set free, and what he means by that is we don't have all of the overhead resistance. We're not stuck in the mud, so to speak, in this consolidation area. We're breaking away from the consolidation area into higher ground is what we'll call it, and a little bit less resistance. So he is completely right. I am very excited for platinum to make its journey higher. I am very well a platinum bull, and I've been waiting for this opportunity here, or maybe not opportunity. I'm waiting for this moment for the big break in platinum. We got Mike Wilson. He was basically kind of like a perma bear. He says Mike Wilson gave up. Morgan Stanley's Mike Wilson gives up. He no longer predicts a big stock market drop. Some of these guys are they're pretty bearish. They're almost like perma bulls to some degree. They continually try to predict market crashes. Harry Dent is another one that's kind of a perma bear. Hopefully, I just said perma bear, not perma bull. Perma bear. And these guys continually predict crash, 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 crash. I'm looking at the money printing like, are you guys talking about a crash nominally, or are you talking about a crash in terms of gold? Now, I would agree with them that there's going to be a big stock market drop when priced in gold. Completely agree. But nominally, I mean, they're printing a lot of money, guys. I mean, has anyone noticed? Like, we got a lot of debt, and the debt's been going up kind of vertical. And so, I mean, I'm looking at this like, you guys really think it's going to drop nominally? I mean, I don't know. Game of Trades, this is what he says here. It says buy and hold doesn't always work. $1,000 invested in the stock market in 1929, 1968, and 1999 would be around $400 a decade later. So when I was doing all of the research for a potential investment strategy, I had adopted a strategy that is called the three pillars. And the three pillar strategy is ratios, market conditions, which is basically looking at cycles, and then technical analysis to get an unbiased view of how people are positioning money in the markets, along with the psychological aspect of the herd. So when I was looking at all this, and this came up. I was looking at the S&P 500 on a big long-term chart. All of these pullbacks here, this is actually, if you really want to know, it's not the red that he's got here. It's a 1, 2, 3. It's a consolidation. The big move occurred in the roaring 20s. Then we had a three-hump consolidation here. Then you throw a trend line across here, and we broke out of that, and we moved on up. In my opinion, if you were to look at the fractal here in commodities, what we did is we created this first hump there, that leg right there, and we're right at the bottom of this leg. It'd be like in the 1953, 54 area here, and we've got all this left of the commodity bull market to occur. I know we're looking at the S&P 500. I understand that. Commodity bull markets occur in these consolidation zones here. And if you notice, it's a three-hump consolidation zone. This is another three-hump consolidation zone all the way to the bottom, and another one hump, two hump, and then third hump didn't pull all the way back. It just ripped. So these are all consolidations where we had greater credit expansion. We had the demographic come through home buying years for these two, creating that credit expansion and the inflation in the system. And when you have a strong economy with a lot of people coming through a certain age group, having kids, spending more money, increased demand, increasing credit expansion and loaning for businesses and new homes and stuff like that, that's what causes a lot of these pullbacks. So that is kind of what I'm seeing occurring here. And I know that we've got this pulled up, but I think this could potentially pull back at some point. I don't know that point yet. I can't, I don't have my read the future genie here, but I think we will pull back at some point and money's going to rotate into gold and commodities, much like it occurred in. Now, I'm going to leave that one out because in 1930 or 31, there was a commodity bull market, but they revalued gold higher. That was kind of like a forced revaluation. 68 was the beginning of when that commodity bull market started to kind of heat up a little bit. We had a big gold mining surge there in the late 60s. 99 was another commodity start of a bull market, which was 99 here and 68, 70 in here. That's exactly where you want to be looking at commodities. Perfect timing. And again, it's clear as day if you look at a commodity to stock ratio. Jesse Felder says 71% of U.S. advisors have little to no gold allocation. It is less than 1% of their portfolio. We also see a similar lack of interest in gold mining stocks, which have largely lost the trust of investors in view of their disappointing performance. So really, no one has a ton of money in this stuff. And that's what's going to fuel the bull market in the future. Each at the beginning of each of these phases, nobody had any money in this crap. Then it shifts and rotates and goes into it, and this is going to look very different in the future when you look at gold allocation of investment advisors. 10 years from now, this is all going to move over to some degree. These things will shift over, and we'll have probably like a bell curve. Charlie Balillo says, entering the year, the bond market was pricing in 6 to 7 Fed rate cuts in 2024. Today, it's pricing in just 1 to 2 rate cuts. What they are pricing in is a potential cut maybe somewhere after July, where it's starting to come on down. So the actual path versus today's expectations, given 515 is this upper line here, and we could go all the way to maybe July, and then maybe we get some sort of rate cut relief. At the end of 2023, we had a much more aggressive rate cutting cycle here. Now, I know a lot of people, they look at these things and these projections, and they put a lot of weight behind it. But I haven't really seen any of these be that accurate, so I don't really put much weight behind these. But this is what people are kind of expecting, just an FYI. Bob Elliott says, most households in the U.S. own their home. They have a retirement account. They are employed, and they're seeing their wages grow around 5% nominal. Says that's enough income growth to keep the cycle going, driven by spending at current rates, and enough net worth rise to keep the savings rate low, in his opinion. I know a lot of people on Twitter here, they like to share a lot of information, and on YouTube about the savings rate, the excess savings rate, and all these other measurements that they think are key leading indicators of a potential slowdown. But a lot of people in the system are pretty well off in terms of U.S. households. I'm not saying that people that are going to try to buy, new home buyers coming in, it's a lot rougher today than it was in history. But the people who do own homes, including myself, I don't really feel that squeezed at the moment myself. But I do notice that things are costing a lot more money. But it's not squeezing me, at least yet, in the sense that I feel like I have to really cut back or do anything like that. But there are things that naturally have occurred in my life that I basically have cost savings occurring, is what I'll say. What if the inflation rate goes up and not down? What if the Fed has to raise interest rates much higher as a result? What if higher rates and rising inflation push the economy into an official recession? And what if a recession results in higher inflation, forcing more rate hikes? Kind of that stagflation environment is what Peter might be alluding to. A lot of questions. I don't really have the answers there, guys. I kind of just see the supply side of commodities looks pretty grim. And then I go look at the debt side. I'm like, well, they're going to be printing a lot of money. And it's like, if they're going to print a lot of money and supply is constrained of a lot of different commodities, we're probably going to see commodities moon here. I mean, that's the way that I view it. And maybe it's too simplistic. I know a lot of people worry about a potential recession, but I'm like, well, I mean, the supply side on copper looks pretty dire. The supply side on uranium looks pretty dire. And, oil doesn't look that great. I mean, it looks like we've got a lot of demand coming up. So we'll see, is what I'll say. I'll take a we'll see approach. Gold Venture says, and there is the close. China keeping the gap premium at 11%. Silver was closing at $35.30 an ounce. Pressure to close shorts in Western trading later today is fully alive. Too bad the TSXV is closed today. And that's that China continuing to put pressure. They have 35.38 for USD in terms of silver, 24.68 for gold. And that's putting that pressure on the COMEX and LBMA, and the physical metals will continue to shift from the west to the east. That's what that pressure is going to do. Andreas says freight rates are rising again. No news out of Gaza is bad news for shipping inflation. Freight rates out of China are rising rapidly again, and we are likely to see the pass-through to goods inflation in the West already in May and June. So the Shanghai Export Containerized Freight Index continuing to move up here in the short term. We've got North Star here. This is the gold, silver, and precious metals. And what he's charting here is gold versus the S&P 500. It says this chart proves it hasn't even begun. So let's take a look at this chart and see what hasn't begun yet. So coming on here, we've got gold versus the SPX on a quarterly log scale candlestick chart. We've got a bear market. So gold's in a bear market because gold is the numerator. So when it goes down, S&P's outperforming. We have a transition period. Gold outperformed in the 1970s. There was a transition period, a short one. Came on back all the way down. SPX was good. This is your bear market in yields. Yields are declining, low inflation. We have another transition. We came back up from 1999 all the way up to 2010-11, where gold outperformed the S&P. Another transition lower, and we're in a transition right now, in his opinion, where we could transition higher here with gold outperforming the S&P 500. These market conditions, when I looked at history and the drivers of it, have been the demographic in the United States coming into home buying years and the real estate cycle going into an expansion phase where we create inflation. This was a real estate boom, and these were busts in the real estate market. So really what you're looking at is the real estate cycle going up and down here. That's what it is. And we're going into an expansion phase of real estate where we're going to build a bunch of homes, and that's going to push this upward, in my opinion. Gold's going to outperform the S&P 500. We've got some ratios here. So we've got uranium to stock ratio, slight pullback, but looks pretty good. So let's go through them real quick. We've got uranium to S&P 500 working our way up here. It looks pretty solid. We've got uranium to M2 money supply ripping to the upside. Looks very solid. And we also have uranium versus gold getting a little bit of a pullback here to a breakout level. And I think uranium could ignite here. It really could. So that's what I see there. So that's all I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We still have Mayday coupon code going on. Mayday is one word, Mayday. And that's all I've got. So we'll catch you next time. This is Finding Value.